Welcome to Magellan's Market Update. Today I'm speaking with Hamish Douglas, the CEO and Portfolio Manager of the Magellan Global Fund. Thanks for joining us, Hamish.
A pleasure, Frank.
Hamish, the fiscal dramas in Europe just don't seem to be going away. What are your latest observations?
Well, my first observation would be that these issues just aren't going to go away in the short term. Greece is going to remain in the headlines at least till the end of the Greek election on June the 17th. Assuming we get an outcome, the Greek situation may settle down for a period after that. We're then likely to go to Portugal later in the year, where Portugal may require another bailout, and we will get the interaction between France and Germany trying to settle what the terms of that next bailout of Portugal would be. Likely to have more volatility in the period ahead. Very likely that Portugal will get a bailout in our view. Then Spain. Spain is a much larger country, fourth largest economy in Europe. Its banking system is in trouble. Bond yields are again rising, and there's going to be increasing focus. There's a lot of focus, but it's going to be increasing focus, and I think Spain is going to be the name of the game for the next 12 months, and there's likely to be more volatility. Although what I would say, the issues are well understood. The regulators and politicians understand the issues. It's not like we've got a black swan event we're dealing with here. They're complex issues. They're going to take a long time to resolve. The central bank, the ECB, has made substantial moves in the last 6 months, particularly the long-term refinancing operation, the LTRO, as it's become known as. When they injected over €1 trillion at 1% interest rate for the next 3 years into the European banking system in December last year and February this year. That has really changed the stress of liquidity in the European banking system, and you see that in key stress indicators that we look at every day. So notwithstanding this heightened volatility, there has been some progress that has been made. The issues, as I said, are well understood. There's likely to be more volatility in the next 12 months, and in the longer term, this is going to take a long term to resolve. You know, governments are indebted; their debts are going up, austerity's kicking in, economy's going backwards, and these deleveraging processes take years. It could take another 5 to 7 years before Europe really comes out of the back end of this and starts growing again.
You touched on Greece. How do you think the Greek issues will pan out?
Well, we think in the short term, the probability of Greece exiting the euro in a spectacular fashion, we think the probability of that event is very low. In the longer term, Greece may exit the euro, but in the short term, that could result in an Armageddon event. We think that is a very low probability. And the reason we hold that view is because the private sector holds very little Greek government debt at the moment. When they rescheduled that debt at the end of last year, and they issued new bonds in exchange for €200 billion worth of Greek government bonds at 50 cents in the dollar. But of course, they issued those bonds at much lower interest rates, so the economic loss to the investors was over 70% of the money. But importantly, those bonds aren't due to mature, the new bonds, for a decade or more. That means there is not practically any debt that is held by external investors outside of the European Central Bank and the IMF and the European Union that can effectively default. So the risk of Greece defaulting in the short term is relatively low. And really this has put an enormous amount of power in the hands of countries like Germany in negotiating with Greece. The Greeks could choose to commit suicide if they wished, and they could choose to exit the euro at the moment. It would be a spectacular disaster for the Greek citizens. It's likely to be very painful for Europe if that happens, but the chance of that choice being made, we think, is very low. The opinion polls for the June 17 elections are actually pretty favourable at the moment for quite a speedy resolution to this. It appears that New Democracy is out in front, and New Democracy, of course, is the party who is pro-austerity and pro the euro, and they're likely to form, if they're out in front, and the party who gets the highest level of votes gets an extra 50 seats allocated to them. If the opinion polls are right, it looks like they could form a government. And Syriza, which is the party who wants to have this game of brinksmanship with the Germans, appears to be in second place at the moment. But as we know in politics, there's a long time to go between now and June the 17th. These things can change, and we'll see what happens. But even if Syriza gets up and they want to have this game of brinksmanship with the Germans, we don't think they hold many cards in that debate. Their ultimate card is choosing to commit suicide to prove a point. We doubt they'll make that choice at the end of the game. So from Greece's point of view, we understand the volatility, we understand the uncertainty that the last failed elections have put on Greece and put on markets. We ultimately think the probability of a disaster in Greece is pretty low, and they have made a lot of progress so far, and let's see how the water continues to flow under this bridge.
Hamish, there's more talk of Spain's woes worsening, particularly with the banking system being under pressure. How are you viewing the latest issues?
Yes, we do have views on that issue. Spain is the elephant in the room. The austerity measures that the new centre-right government is implementing are biting, and unfortunately the unemployment rate is going up. And pre-2008 there was a spectacular property bubble. On some estimates, Spain was constructing 3 times the amount of houses that were required to be lived in by the population each year. So there's been a massive excess supply, and who financed this spectacular bubble in housing? The banking system. They financed the constructors, they financed the mortgages, they are loaded up with loans to this property bubble in Spain, and of course there are going to be massive write-offs required. At the same time, the unemployment rate's going up. It's now 24.4% in Spain is the latest figure, and it's likely to be going up by the day. And what is happening, a little off the back of what's happened in Greece, bond yields are again rising in Spain, and there's this laser-like focus on dealing with the Spanish banking system. Bankia, the 3rd largest bank in Spain, which is an amalgam of 7 savings banks in Spain, is being bailed out to the tune of over 16 billion euros. It's already received 4.5 billion euros in capital, and there's a dispute with the ECB about exactly how that recapitalisation can occur. Of course, that's going to put further debt on the Spanish government's balance sheet as that recapitalisation happens. And there are estimates out there, and I don't think they're unrealistic, maybe there's 100 billion euros of capital that has to go in the Spanish banking system. At the end of the day, if Spain gets shut out of the capital markets, ultimately we think that the European stability mechanism that comes in place on the 1st of July will provide the funds to Spain to recapitalise its banking system if they're not able to borrow those funds themselves. And if Spain totally gets shut out of funding markets, we believe in that scenario the European Central Bank is likely to dramatically expand its balance sheet and most likely enter the secondary markets and buy Spanish bonds to drive down the yields. So we could get a heightened level of volatility. This is a very problematic situation in Spain, but again we think it's very low probability that it's going to result in an Armageddon event for Europe and for the world as a whole.
You've spoken more recently about the economic recovery in the US over the next 3 years plus. Given November's presidential elections, how do you think the economy will develop over time?
No, we don't think the presidential election is going to have much bearing in terms of our, relatively optimistic view that in 3 years' time the US is going to be led into quite a sharp recovery through an increase in housing starts in the economy. We think when housing starts get back to a more normal level, when this excess inventory is used up, and it's our estimates about 3 years to utilise the inventory, housing starts could well double from their present rate of 600,000 to 700,000 housing starts per annum at the moment, back to about 1.4 million housing starts. That will have a massive injection into the economy in terms of the amount of money that's being invested in housing. Of course, it will have a big effect on the unemployment rate at that time, it will have a dramatic effect then on the budgetary position of the United States, driving down the budget deficit. We don't think that equation gets changed very much at all, depending on who's in the White House between Obama or Romney at the end of the day. The issue at the beginning of next year, of course, is the fiscal cliff, where the Bush tax cuts expire and there are automatic expenditure reductions that would come into place back off the debt ceiling extension that was agreed in August next year. There's not a lot of time between the November presidential elections and February next year in order to enact something that would get through that fiscal cliff. Whilst I think we're going to have some volatility and some uncertainty around that time, ultimately we think Congress will not allow a massive fiscal retraction to happen at a single point in time, and we hold that view irrespective of whether Romney or Obama is the president post the next elections.
And Hamish, are you happy with where the Chinese economy is tracking at the moment?
The Chinese economy, we have been proponents of a soft landing scenario where China dramatically stimulated its economy in 2009 and 2010, largely through an expansion of credit through the state-owned banks, partly owned by private shareholders, lending money to local government authorities to build property and infrastructure. Highly effective program, but of course with a program like that where you expand the bank's lending capacity by 80% in 2.5 years, you're likely to leave the banks maybe with some problem loans. And the Chinese government is dealing with the consequences of the stimulation they did to their economy, and the economy is slowing down as they've slowed credit down. In the last 6 weeks, it appears that the Chinese economy is slowing down faster than we have been anticipating. Still a soft landing scenario, but a faster slowdown than we've been anticipating. It's still only 6 weeks of data, and I think everyone needs to be cautious about data coming out of China, about exactly its accuracy, but there is a number of data points that shows that the year-on-year growth in certain areas of the economy has slowed very materially. It's not a recession by any stretch of the imagination. Maybe China grows at 7% this year and not above 10%. So slowing down more rapidly than we thought, but still a relatively soft landing scenario.
And given the slowdown in the Chinese economy and the volatility in equity markets more broadly, are you comfortable with where the global fund portfolio is positioned?
We're actually very relaxed about the portfolio at this point in time. We're in a number of very advantaged areas that are still growing at very satisfactory rates across our payments franchises, across our multinational consumer franchises. While China's slowing down, I think people need to understand, whilst 40% of the revenues of companies like Nestle and Procter & Gamble and Coca-Cola, and even more for Yum Brands and Danone and others, are coming from emerging markets, it's not all coming from China. Yum Brands is very dependent upon China, but we have a very, very diversified exposure across the Middle East, across Africa, across Southeast Asia, across Latin and South America, across Eastern Europe and Russia. These companies are participating in all of these markets, so we're not overly concerned about a slowing China scenario. And of course, we're unhedged to the Australian dollar in the global funds portfolio. That is likely to be an advantage to investors should China slow down more rapidly than markets have been anticipating over time. So we have virtually no exposure directly in Europe where it is. In Europe, it tends to be in healthcare or consumer staples. It tends to be at the very low risk end of the curve. We are overweight a US recovery story. People know our investments in a business called Lowe's, a large home improvement retailer, our bank investments, Wells Fargo and US Bancorp. We believe they're going to be very advantaged, assuming we're right about the US economy at the moment and its likely progression over the next 3 years.
Thanks, Hamish.
Thanks, Frank. A pleasure.
And thanks for viewing. And again, this link will be hosted on the Magellan website in case you'd like to forward it on to colleagues or clients. We're also looking forward to the 5th anniversary of the Global Fund coming up on the 1st of July this year. Thanks for viewing.